So quite a lot of people have been asking me, what are my thoughts on interest versus capital repayment in mortgages? And I know it's not the sexiest subject in the world, but do you know what? It's super important. It really is. So here's my thinking, and everybody has their own thought process. I think there are 3 stages in property. I think your first stage is when you're acquiring property. You are constantly running out of cash. You are constantly on a daily basis checking your bank accounts. You are constantly doing your cash flow planning and your cash flow analysis for like 18 months ahead, right? And you are constantly like having tiny little moments of going, oh my goodness, I'm going to run out of the money. And your whole focus is about acquiring those assets and getting them under your ownership. Yes, of course, in our game, you're going to be looking for discounted property deals, BMV, below market value, or as I call them, wholesale, because you want to be locking the profit in when you buy. But it's gorgeous to lock profit in, but when it's bricks and mortar, you're locking it in on your balance sheet. That's but you're not locking in cash, you're locking in wealth, which is in bricks and mortar, and you can't eat bricks and mortar. So, your liquidity, your cash flow is critical in the early stages. I mean, it took me 3.5 years to become a millionaire. Doesn't that sound fabulous? But I was skint. I was absolutely, utterly skint. I was a millionaire on paper. My assets were worth, once I took away the bank's lending and how much I had in assets, I had way over £1 million worth of wealth, but I couldn't eat it. I couldn't go out and spend it in the shop. It was all property, bricks and mortar. So in the early days, for me, it's all interest only. Why? Because every penny is trying to be captured to buy the next asset, the next asset, the next asset. And for me, that's stage 1, asset acquisition. Stage 2 for me is about pay down, which is about, okay, so my loan to value is relatively high. And I want to push it down for a number of reasons. Number 1, I'm stubborn. For me, financial freedom is exactly that, freedom. I don't want a bank telling me what to do. I don't want a bank, in the nicest way. I'm so grateful that they'd lend me money in the first place, but I'm not here to fund the British banking institution, am I? I'm here to fund and look after my family, my friends, the people I care about, myself, yeah? I don't want to be, I know how much money I pay in interest still, and I've got houses with no mortgages on them already. So to me, second stage is the important one. Second stage is when you've bought the assets and you're happy with the value of the asset base that you've now acquired. And you're saying to yourself, yeah, I can continue to do this cookie cutter, stamp out, go and get more discounted properties because, sourcing discounted deals, buying them, refinancing them, selling them on, paying them down, or refinancing them and getting all your cash back out. That is something that's a cookie cutter model that I know what to do. But actually, now I want to pay down my debt. So then there's some equations, age plus loan to value, less than 100. Yeah, so you're a little bit younger than me. So you might have a higher loan to value. I'm in my 40s, we're not going to ask how many. So it's 100, take away my age, age plus loan to value less than 100. So 100 take away my age needs to be my loan to value, because as you get older, you want to reduce your risk. Yeah. So then it's twofold. Number 1, can you pay houses off in great big lumps? And that is my strategy. I'm an all or nothing girl. I can be like, right, I'm going to pay a house off in 2 months. How do I make that happen? And I will absolutely kill it until it happens. But also you possibly at that point then want to be like, well, can I pay off my entire portfolio in a 15-year period? So am I going to switch a number of my properties to capital and repayment? So if you're a very measured person, then you might want to say, I'm going to switch a number of my properties to capital and repayment. Or if you're an all or nothing person like me, you might say, I'm going to keep them on interest still, but my entire strategy is about paying off the houses now. So most mortgages, not all, you have to check with your mortgage company, most mortgages will allow you to pay 10% down a year. So what you want to be doing is paying them down every year 10%. Once you've got to the point that no more houses will make you happier, and then pay them down 10% a year, even if you're on interest only. So it's not so much do I take an interest only or a capital repayment mortgage, it's more what is my mindset and what is my stage at. My view, interest only at the beginning when you're acquiring assets. Second stage, which is about pay down, you can either take capital repayment and pay them steadily, or if you're somebody like me, who's all or nothing, then what I do is I take a 3 or a 5 year fixed that allows me to pay 10% down, and I say to myself, I'm paying these many this year off, I'm paying these many the second year, these many the third year. Because the problem is when you take a fixed, if you then want to pay the property off entirely, you've got redemption fees, they can be like 9,000-10,000 quid. Well, what's the point in wasting money on a fee because you've got yourself in a fixed? So I would then say you divide your portfolio up, and maybe half your portfolio moves to capital and repayment, and they're just steady eddies, and the other half is still on interest only, but you can pay 10% a year, and you absolutely aim to pay 10% a year. And then I want you to challenge yourself. I want you to say, when this fixed period comes up, I refuse to refinance because it's going to cost me fees, legal fees, it costs thousands in fees, and I refuse to keep it on standard variable. I will pay it off, and then you have to find a strategy to pay it off. So if you have another business alongside that generates cash, boom, pop it in, pay it off, or you can run a buy to sell strategy to pay it off. So really I've changed the question between should I do interest only or capital repayment. I've said stage 1, in my opinion, interest only, all the way, acquire those assets. Stage 2, where I'm currently at, I definitely want you paying down, and you might divide your properties between some interest only and some capital repayment, but even the interest only ones, boom, 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 I want you paying 10% off a year, and I want you to refuse to take out a new mortgage, so at the end of the fixed period, devise a plan to pay the thing off entirely. Why do I do that? Because it goes against the kind of common advice out there, which is hock yourself up and always be in debt, and this is good debt. Well, I do think that mortgages are great debt, because stage 3. Now, stage 3 is when we have a lot of fun. So I have a very large portfolio. Stage 3, you've paid all your houses off, yeah? And now you're going to auction with your monthly cash. And you're buying houses every month with your rent roll for cash, which reduces your cost enormously of interest and fees, and you're renovating them, and you're doing whatever you want to do with them, keeping them or selling them on. You're being creative, you're being energetic, you're being entrepreneurial, your profit has gone much higher because you're not paying any bank costs, and your lack of stress because lack of having to get mortgages. So for me, stage 2, which is payoff, either it's interest only with additional overpayments or capital repayment, is only there till we get to the game of stage 3, going to auction with cash. So there you are. I think interest only at the beginning. I think paying off is stage 2, and then I think buying properties with cash is stage 3. And I'm at stage 2. A key question is, how do I get started in property? Write yourself a plan. I have written you guys a pack, how to write a business plan and deliver business success in property. You can download it now.